Good afternoon, everybody, or good morning, or good evening. Welcome to our BTRM Thought Leadership webinar here today, 2nd of July, 3:30 p.m. London time, or British summer time, I should say. Thank you for joining us, and welcome. My name's Moorad Choudhry. I'm on the faculty of the Certificate of Bank Treasury Risk Management, and we're going to present for the next 15 minutes or so a run-through of my presentation on what bank treasury and asset liability management desks, ALM desks, might wish to be undertaking or following or addressing while banks work their way through this COVID-19 stress event, which is, of course, ongoing, which is still in progress, still in place. And many of the government's responses to the pandemic crisis, the risk, the lockdown policies that we've observed in many countries around the world, they are also still ongoing. So it's difficult to know the final outcome, and that is what makes this stress event a particularly interesting one, if not also a particularly painful one for many bank customers. So let us proceed then. As I said, we'll have time for questions at the end. I have got a little chat box here on the right-hand side of my desktop. If you have any questions, do type them into the chat box. Feel free to type them in at any time, but what I will do, as we're operating across jurisdictions, with a fairly decent number of people on board, what I will do is I will take all the questions at the end in the order that I see them in my chat box. Okay? And I may respond by writing into it, but more likely I will respond verbally. Okay, good. Thank you again. And as I said, we'll have questions at the end if you wish. This is all part of the regular thought leadership presentations and webinars that BTRM presents every now and again. And back in March, I posted a slide deck that still has some commonality with this one here about the initial ALM response, but then we saw government and central bank support measures being announced through April and May. So we've had an update on this, and we've put in a wider picture to consider the higher level risk management aspects as well as the ALM aspects of this current stress event. So let us proceed. So here's our agenda. First of all, a quick run through of the current environment, what we've seen from central banks and regulators by means of in the way of support measures, the very important role of the bank's asset liability committee. Then we'll go through the specific ALM impacts, the ALM implications, and also the actions that it might want to be considering, short and medium term actions. And then I've presented as an appendix a kind of policy checklist, a checklist of actions that you might want to compare against to see if your ALCO and institution has covered these points off. Okay, so first of all, what have we got here? Well, we've got a global pandemic. I forget whether it's been officially declared one or not. I think there was some controversy with respect to that back in February and March. But be that as it may, we have a global phenomenon here that has created severe health as well as economic hardship for people around the world. And it's resulted in policy response from most governments around the world called variously lockdown, which has basically meant that everyone is staying at home and not undertaking any kind of economic activity, especially where this activity involves being in close proximity to someone, which is why we've seen the leisure and entertainment sectors the most heavily suffered of economic sectors. And this government policy response is what has created the economic crisis that we're in now. And this, what I refer to as the market-wide stress event. And responding to this stress event is the challenge for all entities in all sectors. Of course, including banks. Big difference between... May I just ask that all of you put yourselves on mute? May I ask that everyone is on mute while we're doing this presentation? Thank you. The big difference between the last global economic stress, the bank crash of 2008, the big difference, of course, is that this time banks aren't part of the problem, insofar as this is not an existential threat for banks. May I just repeat again, can everyone please have their mics on mute? Because I'm getting some conversation in my earpiece here. If I may ask you please to mute your mics, thank you. Okay, so significantly this time banks aren't part of the problem insofar as it is an existential crisis for them, and they enter this crisis or stress event with fairly robust, fairly healthy balance sheets, fairly robust capital and liquidity buffers, precisely because of the last stress event, because of Basel III requirements resulting in banks having much more capital and liquidity resource on their balance sheet. So at this point, so far, this is not an existential crisis for banks, and they're not part of the problem. But they can, however, be part of the solution. So what have we seen in response to this from countries around the world? They have a lot in common. There's a lot of central bank action, a lot of government support measures. I've got a summary there of what we have seen in the USA, UK and Europe, in Asia and in the Middle East. There is essentially what all these measures have in common is that they have expanded the role and the size of the public sector. Support measures are coming straight out of the public purse. And literally a handful of countries have a public purse that can pay for this. I do mean less than the fingers of one hand. Most countries have to borrow this money, and they will be increasing the size of that public sector borrowing requirement as they work through these support measures. Okay, so for example, what have we seen from the U.S. Federal Reserve? In fact, it was probably early. Most definitely, there's no probably about it. It was early support measures announced by governments and central banks around the world that resulted in this so far not being a money market stress. There's been no illiquidity, dry up or freeze in the money markets. The interbank markets are still open. The foreign exchange markets are still open. And crucially, quite early on, in April, I believe, if not earlier, the Federal Reserve extended or eased the terms of its US dollar swap lines with a number of central banks around the world. And interestingly, they extended these US dollar swap lines to 9 other central banks that previously hadn't been part of this facility, including countries like Brazil and India. So this meant that there was no shortage of US dollars. It's principally a shortage of US dollars that results in foreign exchange and money market freezes, and we haven't had that so far. And so that's one of the main reasons that we haven't seen a market-wide freeze so far in the money and foreign exchange markets. You can see there's a number of other help measures or support measures announced by the Federal Reserve. Similar again for the European Central Bank. They have also increased the size of their asset buying. They have followed the Basel Committee's guidelines on lowering capital reserve requirements, as has the Bank of England. I'll come to the Basel Committee very shortly. They've also followed international guidance on which loans would be considered non-performing if there is an interest payment holiday on them. I'll come again to that as well. But around the world, banks have offered interest payment holidays for 3 months or longer to customers who are suffering cash flow problems. That was actually a support measure initially introduced by governments before the central bank announced it to banks. So there's a number of support measures been introduced which have helped ease the economic impact of the lockdown policy. What has the Bank of England done quite early on? They eased capital requirements. They also cut the central bank base rate from 25 basis points to 10 basis points back in March. But they also reduced the capital requirements. They eliminated the counter-cyclical capital buffer. The Bank of England, the UK, was one of the countries, a handful of countries around the world that had a counter-cyclical capital buffer requirement. It was at 1%. It was due to go up to 2% by the end of this year. That was cut to 0%. It's also followed international Basel guidance on capital buffers being there to be used, being available for banks. They also increased their asset purchase and their lending facilities for corporate entities. So we've seen that central governments and central banks have introduced a number of support measures which have helped ease, at least temporarily, the impact on consumers of sudden loss in revenue for these consumers. So any economic recession has a significant impact on what a Treasury and an ALM function will do for a bank, because they, of course, have as their primary objective managing balance sheet risk, maintaining balance sheet viability. But, of course, again, with respect to 2008 versus 2020, there's no immediate existential crisis for banks, but, of course, what they're seeing is their customer franchise requiring a large amount of support, some more than others, particularly those in industries that have been more affected. Industries, for example, leisure, entertainment, involving social interaction, they've been closed down. They remain closed down. Here in the UK, for example, I understand theatres and cinemas may not be opened until October. Swimming pools aren't open yet. So all kinds of industries that are, all kinds of industries have been impacted, but those that have been impacted more are those that are directly affected by a lockdown policy. No social distancing required. Now, if you're a bank that has this type of customer amongst your customer franchise, then your balance sheet is going to be impacted more. But at the same time, you'll also want to look to support that customer franchise. And here, the role of the Asset Liability Committee is key, because it's got to monitor this customer behavior and customer requirements, also maintain balance sheet viability, and maintain a two-way relationship upwards to the board and downwards to relationship managers. So therefore, the role of the ALCO is very important. And a lot of the policy questions and challenges that I raise in the next few slides, they are, they are for the Asset Liability Committee to address, debate, and to come to an agreement on. Now, what has been the initial market impact? Back in March, there was some fear that there would be a liquidity freeze or a foreign exchange market freeze, an interbank market freeze. I saw a McKinsey report from March that said that they expected a 40% decline in liquidity coverage ratio. They expected the money markets to freeze. We noted back in the middle of March that the spread between the 3-month LIBOR and the overnight rate, what I've called down there the LIBOR OIS spread, OIS meaning overnight index swap, but the overnight rate, that spread widened out to quite high levels, the spread itself, compared to what we'd seen last in March in Q1 2009. That reflected an initial worry about freeze in money markets. That actually came back in again, because after middle of March, we had the announcement of all these support measures from the government and the central banks and the Basel Committee. So that came in, and we haven't now had this freeze that was a worry. So that's a good thing. We haven't seen that happen. That's one less problem for the ALM function to worry about. It's okay. It's still got plenty of other issues on its plate that it has to deal with. But one thing at the moment it doesn't have to deal with is a freeze in markets. But, of course, we should always bear in mind any planning for it, because that is for now. As I say at the bottom of that slide, up to now, there has been little liquidity and funding risk and FX market risk impact. But, of course, if this recession, the economic impact, carries on till the end of the year and beyond, that may well happen. So this still remains a risk to monitor and have plans in place for. Right. So let's go into some of this regulatory guidance, which has made the work of the ALM function clearer, because they can now address this idea of supporting the customer franchise, because they know what they can dip into and they can't. Back in April, early April, I have to admit, I was impressed at the speed of the Basel Committee's response. The Bank for International Settlements isn't necessarily an institution that one associates with rapid response and quick decision-making, but this was quick. On the 3rd of April, they put out a press statement. On the left-hand side, I've got some quotations from that. The one that really struck out for me was this bit at the bottom, this quote at the bottom that I've got. The committee, that's the Basel Committee, the Basel Committee for Banking Supervision. The committee reiterated its view that capital resources should be used by banks to support the real economy and absorb losses. And also later on, they talk about liquidity buffers as well. The text on the right-hand side is my text. As I say there, this statement is significant. In other words, it's telling regulators, it's giving the guidance. Remember, the Basel Committee doesn't set any law. The BIS doesn't have any authority over anybody. They set guidance or guidelines, and regulators follow them. So regulators have, by and large, followed this guidance, and it's basically saying capital buffers and liquidity buffers are there to be dipped into. So if you dip below regulatory minimums, that is not an issue. I'll come to a bit more detail on that in a bit, but it means the ALCO and the ALM desk can now concentrate on understanding exactly what capital and liquidity resources are available to be used, and that will inform an extent of support they can give to their customers. So that's a very important announcement from the Basel Committee back in April. So that's 3 months ago now. Seems quite a long time ago now. We have 3 months of lockdown here. So that's quite a long time ago, relatively speaking, and banks have had that guidance since then. So this has helped a lot in ALM and ALCO policy decision-making. Right, so I've got some examples from the UK to show you, but it's quite a common approach in a number of jurisdictions. So this is by no means restricted to the UK. I've just got some examples from their statements to give you an idea of what banks have been doing and should be doing when they look to see what they can do to support their customers. First of all, the PRA, the UK regulator, the Prudential Regulatory Authority, again, 3 months ago nearly, 20th of April, issued a Q&A, a question and answer statement. That made clear, to me at least, made clear that bank capital liquidity buffers are there to be used, and that dipping below regulatory minimums is acceptable as part of a bank's response to assisting the customer franchise. Okay, a bank would be expected to inform its supervisor in advance of its intention to do this, and also to provide a high-level restorative plan. So we're going to dip into these buffers, but here is our plan for restoring this balance over the next 2 years, for example. Okay, but this is ordinary. You would expect ordinarily a bank to keep its supervisor informed of its high-level balance sheet impact decision-making. But the critical point is we now have these buffers available to be used, and it's worth having a look at this. If you just type into your search engine PRA Q&A 20th April, it'll come up. The reason I've got some extracts on the next page is, again, just to make clear, those two pages there on page 2 and page 5 of this Q&A says capital buffers are there to be used. Now, interestingly enough, with respect to liquidity, that means if you're dipping below 100% liquidity coverage ratio metric, then that's not an issue. You'll be expected to manage it back to 100% and above in due course, but that is not any kind of supervisory issue or licensing issue. And equally for capital, this statement says capital buffers are available. It then goes on to say Pillar 2 capital buffers are available, like the capital conservation buffer. Does that mean Pillar 2A is available? In theory, if I read this text, I interpret it as yes. But certainly Pillar 2 capital is there to be used. If you're dipping below your what's called total capital requirement or your individual capital guidance, and it's dipping below your Pillar 1 and Pillar 2 requirements, and you're using up Pillar 2, you're dipping into it, there's no problem there. It's part of your plan. It's part of your management actions to address customer franchise support. And in the meantime, you have submitted a restorative plan, which doesn't have to be immediate. In fact, they made clear that restoration here in the UK, restoration wouldn't be immediate. If we deem that this stress event is over, say, by the end of the year, there's no requirement that by Q1 next year you've got to be back above your previous levels. No, in fact, what they said was a minimum of 12 months after the perceived end of the stress, you would start to be approaching previous levels. Now, that's here in the UK. I'm sure it's reasonably common in most jurisdictions, but of course each bank will want to have a conversation with its supervisor about this in any case. But that is the general approach that regulators have been taking. I've got an extract, a technical point from another PRA document. They issued a notice in May now, so a month after the previous one, about Pillar 2A capital requirements. Now, generally speaking, a bank's Pillar 2A capital requirement is a percentage of its risk-weighted assets. It's risk, and this is the guidance or requirement given by your regulator. The risk-weighted assets number, of course, changes every month, or changes every day. The risk-weighted assets number changes with your change in balance sheet. So, of course, your capital requirement, your Pillar 2A number, is varying. What they did with this announcement was to say that's been converted to an absolute amount. That absolute amount was what it would have been at the last ICG or capital guidance approval number. So that number is now static for the time being, and so your Pillar 2A number isn't going to be fluctuating as your RWA changes, your risk-weighted assets number changes. Now, the text in blue, the top in the left-hand corner, in the left-hand side, is a direct quote from this paper. The text in red at the bottom is my interpretation of most of it, which is basically a practical effect of this is to assist increased lending without leading to an increased Pillar 2A capital requirement. This is particularly relevant or significant, materially significant, where the lending is to 100% risk-weighted asset, 100% risk-weighted customers. Okay, so exactly the sector that you might expect a bank to be doing more lending in, the small and medium-sized corporate sector and the unsecured retail sector, the overdraft, for example. So 100% risk-weighted assets, this is providing assistance by not having an impact on your Pillar 2A requirement for the time being. Now, this is specific to the UK. Not every jurisdiction has done this, but it's an example of the type of support that the regulator is giving to banks as they look to support their customer franchise. Oops. If you did type a question in earlier, please do type it back in again, and I'll look at it at the end because my chat box has cleared itself. So apologies again, my laptop turned off. Don't know why that happened. I'm very sorry. Let's hope it doesn't happen again. So just to carry on, finishing off on this slide, excuse me. That's again an example of the UK regulator assisting banks to use their capital base to support the customer franchise because they've now made it easier on terms of the the calculation of the Pillar 2A capital requirements. Okay, so that was that one. EBA, the EBA itself has produced its guidance, detailed guidance. Have a look at the final report from about a month ago, 2nd of June. There's one or two important points there. Specifically, I want to highlight this bit about guidance on loan repayments. As you would have seen, a number of countries around the world, governments have either instructed banks to, or they've provided the support, or banks have offered payment holidays, interest payment holidays, principal and interest payment holidays on different types of loans, mortgages, personal loans, credit cards, car loans, so on and so forth, commercial real estate. So where that's happened, ordinarily you would expect a loan that ordinarily doesn't cover its payments in 3 months has gone to non-performing. And in terms of the accounting treatment, what's the IFRS 9 accounting treatment, the expected credit loss of such a loan is going to worsen. So you move from what's called stage 1 under the accounting IFRS 9 concept to stage 2, and that's a worsening of your loan book quality and requires a provision to be set up against alongside this expected credit loss amount. So the EBA guidance made clear that under these sorts of current conditions, these types of forbearance or loan interest and holidays, they don't trigger an automatic classification from stage 1 into stage 2. So again, this isn't impacting the capital base in the way it would ordinarily. Now, this is fine temporarily, but of course, and this is something the PRA have stated, when it comes to credit risk management, a bank still uses its own judgment as to what its credit risk exposure is and what its expected loss is to be. And it's got to base that on its own estimates and analysis. Now, it's all very well the guidance being there's no automatic movement or transformation from performing to non-performing if one of your customers requests a payment holiday, but it's up to the bank to determine which of those customers will be viable again at the end of the support period and which of them are now, in effect, potentially zombie companies or zombie borrowers because they never restored to a state of financial health. So in that case, irrespective of the guidance, you may want to apply some provisioning against it, okay? So it's still up to the bank to apply its own judgment, but there's no automatic triggering from stage 1 to stage 2. And that's why I've just highlighted those two parts from paragraph 4 of this EBA guidance. Again, worth having a read of that. This is very common around countries around the world, not just in the European Union. So it's worth having a check at that or your own supervisor's announcements if they've made some pronouncements on it. So that's the regulatory support. We've seen all manner of regulatory support from central banks, the guidance on the support measures, the guidance on use of capital and liquidity buffers, the guidance on the treatment of loans that have had a payment holiday requested. So we've seen all that. Now let's go back to what the ALCO should be debating now, the extent of customer support. Okay? Now, if that's a desire of the bank, then it should debate this. And it's really up to the bank's executive committee responsible. I keep referring to the Asset Liability Committee because I think that's the most appropriate forum. It could be the executive committee, the management committee chaired by the CEO. Be that whichever committee it is, what they should be doing is recommending for approval to the board of directors or the supervisory board various measures of customer support because they're going to impact the balance sheet. So, for example, first of all, agree that supporting the customer franchise is what the bank wants to do because that's a cultural thing. Different banks have enacted different levels of support. So first agree that at ALCO for board approval and then look at how specifically you can assist customers. It's not just through payment holidays that you can do that. I have seen different types of support. I have seen a bank in the UK, that has not just given a loan payment holiday for 3 months. They've also frozen the interest on the credit card balance. This is specifically for credit card customers. Now, normally, what I've seen most banks do is apply the payment holiday, but they roll up the interest. So ultimately, after 3 months, or 1 or 2 or 3 months or longer, if you desire, you've still got a capital balance to pay plus added up interest. So you haven't really escaped it, and you could just be storing up more trouble for the future if you're a borrower. This particular bank has said we're going to freeze the balance for those 3 months, and there's just a minimum £1 payment. Now, that's a genuine level of support. I haven't seen that too often, but obviously this bank has made the decision to do that. The capital impact, the balance sheet impact is more severe for this bank, okay? So, again, the extent of support is for ALCO to recommend for board approval. Pricing of loans, some banks have waived overdraft fees, loan setup fees. Some of them have waived overdraft interest, so it's like a interest-free overdraft up to a certain amount. The extent of the support is for your ALCO to debate and recommend for board approval. What does this mean for risk management? Well, the imperatives are obviously at the high level. What does this mean for our balance sheet treatment? We have no idea about how the recession will end up, how deep or severe it will be. So we'll need to make some assumptions. We need to make some assumptions about what will happen to the economy when government support measures are withdrawn. You would have seen certain countries having this kind of job protection scheme, whereby the government pays the salaries of employees that would otherwise be made redundant. Here in the UK, we call it a furlough scheme. Now, that's going to unwind itself in October. At the moment, there are 10 million, just under 10 million people on this scheme. So their salaries are being paid by the governments, not by the companies, via the companies, but the government's taking the bill. Now, what's going to happen to those employees when the retention scheme support is unwound in October? How much of those 10 million will still have a job to go back to? The worst case scenario I've seen is 50%. Now, that's a big rise in unemployment. I mean, that's serious business. So what do we as a bank need to address? We need to run various stress scenarios to determine what it means for our balance sheet if unemployment goes up by that much or if it goes up by a little less. Okay? So the impact is on our customer franchise. We need to see what that means for our balance sheet and make policy accordingly. Some banks, as I say on that slide there, will be affected more than others because their customer franchise is more greatly impacted. If you are lending to the leisure and entertainment sector, or you have a big commercial real estate book, I mean, what we see now, well, this is a virtual seminar. People are working virtually, people are working from home, meeting from home. Office space will not be in such demand. So if you have a big commercial real estate book, office rental income, that's going to be reduced by companies. You're going to be looking at a more severe impact. So depending on your exposure to the market is going to drive your response to balance sheet management. Again, we know that at the moment so far there's no market freeze, and as I mentioned, thanks to speedy support measures announced from central banks, we know that liquidity coverage ratio is not 100% minimum now, because if it dips below that, there's no issue. But at the same time, we know, my third bullet point there, that it requires only one bank in any particular jurisdiction. It doesn't have to be systemically important. Only requires one bank to find itself in difficulty, especially liquidity difficulty, for the market to suddenly start withdrawing. Insofar as there's a knock-on effect. People draw lines out, you see a run on the bank, it has a knock-on effect. So that's still a risk. That hasn't gone away in any jurisdiction. So we need to be mindful of that, and that's why I've got a checklist on cash management to show you later. So we still need to address and plan and stress scenario test for reduction in capital and liquidity levels, and have in place a policy action in response if things do get worse. Okay, so balance sheet management, some more implications for us. The full impact of the crisis will not be known until sometime after the stress event has abated. Yes, because we're still in it. We need to understand what this means for our credit risk management policy and our loan origination policy for existing customers and for new customers. Okay, so first of all, we need to agree to what extent we want to support the customer franchise, and then also what this means for our credit risk policy for new customers as well as existing customers, and what our own view on this is, how much capital is available, to what extent do we want to make use of available capital. I've got a point there about proactively managing non-performing loans. This has already started. We've already seen an increase in defaults since lockdown measures were introduced. And as I say there on that second sub-bullet point, credit-related losses will be a significant driver of balance sheet and P&L performance during the next year and in the next year or two, actually. So we want to have some review of our management processes for non-performing loans at this point, because we will expect an increase in defaults, especially when government support measures are withdrawn. Okay, so think about the management of non-performing loans and what support for a customer is available. I've got a point there about extending support, freezing, not rolling up interest. Something else I mentioned recently, sometimes it's a better idea from both perspectives, from both the bank and the customer's perspective, to not zero the loan freeze, not go to zero for 3 months, but actually to have a token amount. Previously, the loan servicing amount was £500 a month, and then move it down to 100, because through past experience of past recessions, we know that retail and small corporates, when they have an element to pay, it's more in the forefront of their minds and they're planning for it. When you just zero it to a no payment of 3 months, it slips subconsciously to the back of their minds. It's a behavioral thing. So think about what sort of support you can give. There's more than one way to support the customer. There's more than one way to address non-performing loans, forbearance and restructuring before you go into recovery. Credit risk provisioning is the big cash management and ALM and credit risk provisioning are the big parts of ALM here. Credit risk provisioning. So we need to have a view on this. We'll need to have a view on what our policy should be for provisioning, where we give loan payment holidays, where we originate new customers who are coming to us under distressed circumstances. Okay, so we've got the regulatory guidelines. I've just showed you the EBA extract. Worsening credit risk perception can be viewed as temporary, so there's no immediate loan provisioning required. But and this is designed to help banks support their customers. But at the same time, as I say there, just after the brown text, the bank is still responsible for managing its credit risk. So we still need to make a judgment call on this. Now, if it's possible, if our data analytics supports it, then we should be as much customer and sector specific as possible. If we can not have the black box approach, go to the website, put in your details, get a credits grading, and then approve a loan or not. If we can be as customer specific and sector specific as possible, that will actually aid better judgment, better decision making. When I look at model risk in a bit, I'll explain a bit more on that. But of course, that's not always possible. Some banks don't have the data analytics capability to do that, and they will use the model output because it's a black box origination model. But if it is possible, it will inform better judgment. Now, the last point I think is worth doing, if you haven't already done it, it's worth doing now. Run various stress scenarios to see what that means for your balance sheet, because that will inform what support you can give and still have a viable balance sheet. In fact, take it to its extreme. Perform a reverse stress test, which is something you would do ordinarily under regulatory rules for the ICAP, capital adequacy process, and the ILAP, liquidity adequacy process. Perform a reverse stress test. That's the test or the scenario that the balance sheet doesn't survive. It breaks the bank. Perform that and then work backwards from it. Because if you know that under these certain circumstances, the balance sheet is bust, is not robust, is not viable, then work back under slightly less, each step of the way, slightly less severe scenarios, and then that will inform what support is available. Because you will get to a point where you can have a kind of stress impact, higher loan default levels, higher loss of P&L, higher liquidity outflow. You can get to a point where you have a more severe scenario, but the balance sheet is still viable. You've worked backward from the reverse stress test, and so then you know to what extent your balance sheet is available to support the customer. Okay, so undertake a reverse stress test and use the output of that to work backwards to see what extent of support you can give. Now, you might say to me, well, all right, how do you define failure then? Previously, under a stable environment, if I dip below regulatory minimums, I'm no longer a going concern because I'm below regulatory minimums. I've just been told I can dip below those. So at what point do I fail? That's a good question. You could say at the point where you get to the capital level remaining that is just sufficient to wind yourself down, that's probably failure. So work back from that. But define what failure means as well as part of your reverse stress test, and then work back from that. That's a good information point for you. More on credit risk provisioning, how best to overlay practically government support measures to your model risk assessments. This is an interesting point. You look at model risk or models, they're going to be showing extreme outputs now because we're in a stress event, okay? So, and also they won't be incorporating government support measures. So like loan guarantees. In the UK, for example, the government has guaranteed to banks up to 80% and in some cases 100% of a loan made under distressed circumstances. So that has no capital impact other than the 20% part for the banks. But your own credit model may or may not necessarily be able to incorporate this government support. So take that into account. Also, the second bullet point in brown there, blanket treatment or specific by customer type. Again, if you can do it on a customer by customer basis, if you've got the resource and the technical data analytics capability to do that, that will inform better judgment as well. Loan terms of trade to maximize flexibility as part of your customer support objective. Consider altering the terms of trade. In terms of, you've got a loan, but you may consider restructuring it into shorter terms or originating new ones that are shorter terms, more simple products, or revise your own risk appetite. I'm going to come to that in a bit as well. So for new customers, shorter loans to tide them over, but also more vanilla products to avoid the complexities associated with more complex products. Complexities in risk management, I should say. What about the treatment of loans granted a 3-month payment holiday? I've already introduced this, the interest rolled up or interest free. There's going to be a P&L impact, so you want to be updating your budgets. I've talked about the IFRS 9 stage 1 to stage 2 transition. This is the key point. Ultimately, it's your judgment on at what point you're going to be transitioning them, okay? And your models may or may not be able to help, because I said they won't have an idea of the government support available, and of course, they may have a severe reaction when government support is withdrawn anyway, because they'll be extrapolating the earlier crisis event. So this one is the key point to address. What's your provisioning policy going to be? And again, I'll reiterate, if you can do it case by case, sector by sector, you'll be able to get better judgment decisions made, a bit, hopefully more accurate analysis to base your judgment on. I've got an early warning indicator there for you, just a second from the penultimate bullet point. Observe sectors that are not necessarily big users of liquidity lines, overdrafts. For example, high net worth individuals or large cash-rich corporates. If those two types of customers aren't in your customer franchise, perhaps you can obtain the data from elsewhere. But if they are, you've got the data firsthand. Ordinarily, if I see two customer types like high net worth individuals or large cash-rich corporates who place big deposits with me and don't usually use overdraft facilities or liquidity lines, and they're suddenly, or over time, they're withdrawing deposits and using overdraft facilities, I've got an early warning indicator of a much more severe recession to come. So as much as possible, make use of early warning indicators to get some idea of where this recession is headed. Okay, just a bit more on what ALCO can be doing with the balance sheet. Just more specific now, I've introduced at the start the role of ALCO. I've got some action plan points to raise for you. First of all, I mentioned earlier the two-way communications and management responsibility process of the Asset Liability Committee. First of all, downwards to provide direction to relationship managers, because the customer-facing relationship managers will want advice and guidance on, okay, to what extent can we ease terms? Can we extend facilities? Can we increase limits? To what appetite have we got for greater credit risk? ALCOs need to give the direction on that because they'd have done the analysis. So a conversation I've come across many times is small corporates and retail individuals asking for increases in overdraft limits. They're in a stressed environment. Ordinarily, the credit underwriter would probably turn down that loan. But now, if we're dipping into capital buffers, we're increasing our appetite possibly for more risk, they may approve it because they don't want that person to be going bankrupt. So again, that's advice and guidance given from ALCO to the relationship managers and the business line credit underwriters. Anything ALCO agrees, if it needs board approval, is going upwards to the board for approval. So there's a two-way, upwards and downwards, balance sheet management responsibility of the Asset Liability Committee. The second point there, hold extraordinary Asset Liability Committee meetings as often as possible. We're all meeting virtually now, so there's no problem with holding an extraordinary ALCO daily if you need to. You want to be observing customer behavior. You want to be making decisions on managing the balance sheet. So meet as frequently as required to sign off on management actions required to support the customer franchise and indeed manage the balance sheet. And of course, you're going to be monitoring the balance sheet daily as far as possible, as accurately as possible, to see what's happening in response to customer behaviors. I've talked about holding the extraordinary ALCOs as often as possible. Cash is king in this environment. What does that mean? That means, I don't mean physical cash. That means in a period of uncertainty, you don't know how large your cash balance needs to be. I think you may want to increase your instantly available liquid cash, whether it's balance at the central bank or balances held at other banks, that you want to have it instantly available, because in any severe environment that's continuing, you never know when there suddenly could be a freeze in revenue or an impact on capital, and such that you need to obtain cash instantly. So cash is king in this environment, and the liquidity book, your high-quality liquid asset buffer, should be optimized as far as possible to this, with this in mind. Of course, monitor your liquidity metrics as well, because they're going to reflect greater use of credit facilities as well as withdrawal of deposits, and update your funding plan and liquidity contingency plan in response to this change in liquidity metrics. As I said, on both sides of the balance sheet, you're going to see increased customer behaviors, increased lending lines, increased withdrawal of deposits. That's going to be impact your liquidity metrics. ALCO needs to monitor that very, very carefully. I've talked about the use of capital buffers being approved, so that's fine. So 3 action plans that ALCO should be addressing. Think of this as an immediate one, which should have been in place from March onwards, short-term one and a medium-term one. So let's have a look at some of them. I'll summarise by this. Immediately, first of all, if this hasn't already happened, you confirm the ALCO's objective of supporting the customer franchise and to what extent. Also, review the balance sheet position straight away and address how much is available for capital and liquidity. Make sure you know and absolutely to the minute the bank's liquidity position and cash flow position at any time, real time if possible. And of course, daily monitor customer behaviours, loans and deposits, withdrawals and increase of notionals, so that you can see the impact on the balance sheet straight away. In the short term, you're going to be updating your funding plan, because obviously the 2020 funding plan needs modifying because of customer behaviour changes, and also adapting or updating your 2020 and 2021 liabilities and funding strategy. And also just dust down, I shouldn't say dust down, because in theory the liquidity contingency plan or your contingency funding plan shouldn't be just put away in your filing cabinet if it's hard copy and gathering dust. It should be a living document. But get familiar with your contingency funding plan to make sure that you have it to hand, know what to do if we do enter into a liquidity crisis. In the medium term, we want to take away lessons learned from this crisis and inform our policies going forward. For example, the adequacy of the risk management framework, also the adequacy, any lessons learned for our stress testing, any lessons learned for what our minimum buffers should be, what our data analytics capability was. Did it enable us to have this accurate balance sheet picture on a real-time, immediate basis, daily basis, or did it not? Because if it didn't, maybe that's a priority for upgrading our data analytics capability for balance sheet risk in the future. I've talked about seek to integrate or better integrate data analytics and IT framework. Also consider, and this is not a trivial exercise, also consider whether the traditional departmental structure of a bank is the model going forward for a new normal environment, whether in a stress or not. What do we have at the moment? We have profit centres and cost centres. We have siloed departments. Going forward, perhaps a more cross-functional team where the senior manager has his or her team with him or her, but also support teams in the same group, reporting lines are the same, and the support teams are those that are necessary to enable the business lines to conduct customer business. So perhaps changing that departmental structure is a more optimum operating model and framework, a management framework going forward. That's not a trivial task, but I think it's a lesson learned. So that's a medium-term takeaway as well. Right, now what I've got over the next few slides is a set of checklists for each of the balance sheet actions that I've been talking about in the last 40 minutes, okay? So I'm not going to go through all of them. Do please have a look at these slides at your leisure. I believe the slides have been made available to you. If they haven't, I'm assuming they will be made available to you very shortly after this presentation. So when you do have the slides, do have a look, and this recording, do have a look through this checklist just to benchmark, if you like, with your own ALCO processes. So I'm not going to go through every line here. We're just going to headline what the checklist is. In the first instance, cash management. I talked about the cash position, having some minimum buffer of instantly available cash. Look at what the HQLA composition is. We did see some widening of bid-offer spreads in the Eurobond market, the secondary bond markets back in March. If bond markets do suffer illiquidity, having non-sovereign bond HQLA components may not be optimum. So perhaps look to monetize non-sovereign bond HQLA holdings into more immediately liquid bonds or cash. Again, also in respect to cash, monitor customer deposit behaviors because we're still carrying on doing business. We still need to raise customer deposits. So as well as monitoring withdrawals, what should we be doing to bring in more customer deposits? If that means raising rates for contingency purposes or more attractive products, then that's the debate for ALCO. Customer franchise, I mentioned monitor customer deposit balances and also look at the use of liquidity lines and overdraft facilities. Again, you'll see an increase in this. So to what extent can you support this? But also to what extent does this impact the balance sheet analysis inform our decision making? Central bank, be familiar with all the central bank support facilities that are available, because a number of jurisdictions, the central bank has introduced new ones. And if you are using central bank facilities, generally the collateral that is used, you want to use facilities that have a wide collateral eligibility and the lowest possible haircut, because the higher the haircut, the less funding you're getting. So just get very familiar with all the facilities that are available to you in case you need to make use of them. More on balance sheet risk, very important, especially if you're lending to customers in a foreign currency. You don't have an organic funding base in that currency. Monitor your FX position, monitor and make use of all available FX funding sources. Make sure you have some contingency available, or what the plan is if there is a foreign exchange freeze. Interest rate risk in the banking book is less of an issue in a current stress environment, but you may want to consider immunizing everything to floating in the current environment, because we don't know where rates are going to go. Collateral management, I would expect to see higher calls for collateral as we see credit downgrades amongst banks, and we also see higher negative mark-to-markets on derivatives portfolios. So again, monitor your collateral requirement and stress test that, scenario test that, to see if that's going to increase under what circumstances, because you've got to plan for it. Data analytics, again, if you're not able to get a true, accurate balance sheet position up to the minute, that's something to bear in mind going forward. And also transparency of your MI. It's very important for Treasury, risk, finance, the business lines, ALCO as a whole, to get as accurate management information as possible, real time, reflecting customer behaviors. And if that isn't possible, then you want to think about that as a medium-term plan. So here is a short-term, as opposed to medium-term, balance sheet risk checklist. If you look down the left-hand side, I've talked about collateral, the left-hand side of each of those tables, the left-hand column. Customer loan impacts, that's a P&L impact, payment holidays. Increased drawdown of overdrafts, again, that's a capital impact. Customer deposit withdrawals, that's a liquidity impact. Go to the other box. Wholesale funding, if you make use of wholesale funding markets, have they in any way been withdrawn to you? Derivatives funding, if we see a worsening of the mark-to-market position in your derivatives portfolio, that's causing a higher collateral funding requirement. Potential illiquidity in money markets and FX markets, very important to monitor that and have contingency in place for that. And finally, one that is no stranger to the Eurozone, but is something that a lot of jurisdictions should be addressing just for sensible risk management. Consider what would happen if your central bank moves to negative. We have some observations to make in the Eurozone, where they've been negative for 6 years now, and they're now at minus 50 basis points. What would it mean for your bank if you're in a jurisdiction that isn't and has never been negative, but may go to it? In the UK, we're at 10 basis points base rates. So it doesn't go very far before it's into negative territory. What does this mean for your bank if they go negative? What does it mean for your communications to customers? What your pricing is going to do? So ALCO should be having this conversation so they can agree some communications and policy points and pricing points, so that if rates do go negative, it'll know what to do. It's only sensible to have that conversation and debate, and if necessary, recommend something up to the board for approval. Okay, preserving the customer franchise. I don't think there's anything new in that one. So I'll get a recommendation. Yes, that's fine. Keep regulatory informed. That's fine as well. I think I've covered everything on slide 34. Immediate action points. Slide 35, I've talked about monitoring customer behavior, monitoring drawdown of liquidity lines and overdrafts, withdrawal of deposits. I've mentioned the early warning indicator, monitoring the FX position, very important if you foreign currency lending. Clear and transparent communications to all stakeholders is always important. I've seen different banks do this to different extent, actually. I've seen some banks ahead of the game. You see adverts on TV, on social media, on newspapers. You see on the billboards. You see announcements. Some other banks have been noticeably quiet. So I think clear and frequent communication to your customers is only sensible. And keeping the regulatory authority or supervisor updated on your balance sheet position, absolutely, that you would expect to do that under the normal course of business. So that's fairly straightforward, that last bullet point. Any additional action points? I think slide 36 is summarizing what I've mentioned. The top bullet point and the second bullet point obviously remain within risk appetite. If you feel it's necessary to temporarily change risk limits, then ALCO must request board approval and get that done. For example, increased limits for credit risk or concentration, or increased limits for liquidity risk. So changing risk limits temporarily to facilitate this is perfectly acceptable behavior, as long as it's been debated and approved in the right way. but seek to remain within your limits, especially your recovery plan triggers, unless you're changing the limits, because you don't want to go into red territory unknowingly. Okay. Monitor all your key liquidity metrics, and also, again, scenario test them on a monthly basis, and also consider a longer extended period of stress, say up to a year. Monitor the board, keep the board informed, ensure stable funding, continue to raise customer deposits, continue stress testing I've talked about, weekly review of your risk appetite statement. Ordinarily, you might review your risk appetite statement once a year. I think a much more frequent review of that is very important. And requesting temporary changes to that limit, I think, is logical behaviour if balance sheet management and customer franchise support demands it. Medium-term strategy, I think I've mentioned most of this. Obviously, we've got some lessons learned to take away. We've got some understanding of what our stress testing should look like in the future, what our minimum buffer should look like, how long our minimum stress period should be. I think a stress period that is assumed to last for a year makes eminent sense now that we've observed this pandemic crisis. We want to make sure that we maintain this adaptable speed of response that banks have shown up to now. Banks have made decisions and policy changes in a matter of days that might have taken a month to do previously. So let's look to maintain that speed of response, the ability to take quick decisions that banks have demonstrated so far. Data analytics, can I integrate the data MI? If I can't, let's prioritize it. Review my risk management framework to make sure it's fit for purpose, because there could have been some parts of the communications or the approvals or the sign-offs that could have worked better in the stress. Let's make that change going forward to take a lesson learned away from this. The other 2 points I think I've mentioned. Flexible and adaptable risk appetite statement, I think in a stress is important. Is there anything on slide 38 that I have not mentioned? No, I think not. I think slide 38 I have mentioned. The last bullet point in brown at the bottom, what I call smart treasury. If you can have an integrated risk dashboard, all of it at your fingertips in front of you, real time, reflecting customer behavior, it makes balance sheet management a lot more efficient and your judgment a little bit better. So if we're able to do that, I think it's good value add. Okay, so what does this mean in terms of conclusion? First of all, we know that stress events always are a little bit different. The next stress event won't be like this one, just like this one wasn't like the last one. We don't have any existential crisis yet for banks, but we do potentially if our customers start suffering severe financial distress. We should be looking to support the customer franchise, but that's not just a straightforward, yes, let's do it. It needs to reflect what our balance sheet position is and what we think it will mean for our balance sheet going forward. But if possible, of course, respond positively and proactively to customer needs. We should stress test in the future and have a risk appetite statement in the future that reflects a potential one-year-long stress event. That's why I put that point in red. Data analytics is very important. That's also a point in red. And also, is there any silver lining? What do I mean from that? What can we take away from this that is a strength? I've seen some banks turn down new customers because they've said, oh, we're only dealing with existing customers. I think that's a mistake. I think a customer that you help today that is a new customer will remember you when that customer is in a more stable financial position. So there are opportunities here as well as a risk management issue. And I think ALCO, again, should be recommending for board approval anything that comes out of that. So this time around, banks aren't the problem, but they aren't part of the problem, but they can and should be part of the solution. And I'm going to conclude there. I have got for you to look at in your own time just a policy and management actions checklist. Do have a look at that. Compare across checklist what you might be looking at your ALCO today. Okay, I've just 5 slides of your policy and management actions checklist for your ALCO to be going through. Okay, and seeing if that's everything that's all covered off. Okay, and then finally I'll finish on this last slide. I'm not usually one for levity or humour in my presentations, but insofar as this can be construed as a joke. But on LinkedIn a couple of months ago, I saw this posted by somebody. What has been the biggest driver of improvement in your data analytics and modeling capability? Is it 1, the CEO, 2, the CTO, or 3, the COVID-19? And I do think that has brought up in priority our ability to number crunch our balance sheet metrics and our balance sheet risk exposure. Okay, thank you very much for your company. Before I leave you, I'll recommend those two readings for you. The relevant chapters are noted, and then I will go back to the conclusions. And that's the conclusion of this presentation. We're right on time, but I do have just a few questions. So if you have the time, I will go through them. The first question: how does MDA restrictions fit into this? If Pillar 2A is dipped into, please can you type out what you mean by MDA? Forgive me, that doesn't familiar to me. I'm interested to hear if you think banks will utilize their capital liquidity buffers in line with the regulator's explicit tolerance. Do you not think that there will be a stigma attached to this? That's a very good question. I'm going to take your second question first. Not this time. What I've learned from this crisis is that a market-wide stress doesn't come with this stigma. So unlike a firm-specific stress, if you dip into your buffers or your minimum requirements of the central bank or your regulator just yourself, then there is stigma and you don't want to go there, which is why I always used to advocate buffers on top of buffers. What I've learned from here is if it's a market-wide stress, you don't need the buffer on top of the buffer because you can dip into what it's there for, Pillar 2A, Pillar 2B, and also LCR. So I do think some banks will do this, and provided they are informing their regulator and giving the restorative plan, I see no stigma attached to it. That's the one big difference between a market-wide stress and a firm-specific stress. I have a basis question. As we know, banks having deposits and borrowing on liability side and investments and advance on asset side, how does loan moratorium impact on net interest income and bank credit rating? If NII goes down as banks will pay interest for deposits and borrowing and defer for advance release, further cost of borrowing would become high for the bank. You are quite right, of course. If you remember when I showed you the little policy action checklist in 2 boxes, I showed you the P&L impact. One of the things to consider is if there is a loan moratorium, an interest moratorium, it's impacting your P&L, certainly in the short term, whereas your funding cost is the same. So your NII is depressing, okay? That's expected, which is why you revamp your budget, you adapt, you modify your budget to reflect this. And if you're rolling up the interest, in theory, from an accounting perspective, you are getting that P&L back. But while you're monthly monitoring your net interest income, that is dropping. Will that lead to a credit rating downgrade? Not necessarily, because that's a function of a number of factors, not your immediate P&L, including your capital base. But of course, depending on how this long goes for, it will depend how severe it's treated. If it's a long-term issue, then of course there's a potential. This will impact P&L. That's the support you're giving the customer. Banks state they no longer fund themselves in the interbank market LIBOR. With the possible cessation of LIBOR, what advice can you give to ALCOs to manage the basis created by lending to corporate, medium, still on LIBOR, derivatives funding overnight to Treasury ALM? Okay, that's a very good question. It's a very topical subject. Even if I had the time left today to do it, I would need longer to address it. LIBOR is significant for certain banks. I hope that every bank has ceased originating any new LIBOR exposure. But obviously, if you are lending, you need to redocument every single one of those loans, which is why it's such an onerous headache. On the derivative side, it's less of an issue because derivatives come under a standard ISDA contract. So the ISDA contract will change and you will start referencing your relevant RFR, say SONIA or SOFR or what have you, or ESTA. Treasury ALM should be looking to transform everything to a overnight basis, and the business line should be looking to transform loan docs, and we should not be originating any new LIBOR-linked risk. But that is it's an ongoing issue. And because we don't have the final form, there's still some uncertainty. I wouldn't wait for that. I would go ahead with ceasing origination of any new LIBOR exposure, changing the documentation. Where a loan doesn't allow that, you need to renegotiate with the customer. On the derivatives side, derivatives desks, you fund them through the FTP process as normal, and the derivative contract will move to the reference rate overnight. So that's less of an issue. But the loans linked to LIBOR are a legacy that needs to be addressed, and of course requires loan documentation, redocumentation. What would you say about FTP pricing during COVID-19? Do we need to change approaches? That's a very good question. You don't need to change your FTP policy, but if you find your FTP curve, if that's being impacted because of a change in your cost of funds or the driver of the FTP curve is changing, then your FTP rate will change. I don't think the policy needs to change because the policy can stay the same. Your pricing may well change. I mentioned on an earlier slide that you might want to give more benign pricing, waive fees, waive overdraft rates, that sort of thing up to a certain amount. Does that mean you change the FTP price? No, not necessarily, because you've made a policy decision to help the customer. So the FTP rate may well stay the same unless the curve is changing for its own reasons, but all that is happening is the business line is reporting a lower P&L. So the policy doesn't need to change. You just need to make sure that your FTP curve, or your grid, if you're using a grid, your FTP input is updating with what you see in the market, and your cost of funds, where the cost of funds are an input, your term liquidity premium. The key input to your FTP curve is your term liquidity premium, so that should be updated, and that updates the FTP curve. You don't need to change the policy, but the rates may well be changing. And if you have made a customer support decision to reduce lending rates or waive fees, then that's impacting the P&L. But it's a strategic decision, so the bank is simply wearing it. It doesn't need an FTP change. Okay, did the chap who posed the question about MDA retype? Because I haven't been able to answer that one. Otherwise, I haven't seen it. So in the absence of that, the absence of any more questions, I hope that has been of interest and of value to you. Do please send any follow-up questions to BTRM, your contact at BTRM in the normal way. Do please get in touch if you haven't received the slides in due course. And as I said, I hope you've had a good... oh, hold on, we have another question. Have been mentioned to keep the bonds HQLA is not most cost-effective to keep directly cash in central bank considering the euro yields? Probably selected 2A assets. Well, the eurozone is where you don't want to have the cash in the central bank because it's minus 50 basis points. This is a function of your jurisdiction. If your central bank is paying a positive interest rate, then while you seek to increase cash balances for instant liquidity, then the central bank is as good a place to keep it because they're paying a positive rate of return, or at least they're paying zero. If they're paying negative, you may want to look elsewhere, but all the options are limited. However, there's a crossover here. These 2A assets or the 2B assets pay a bit more, but of course, they're the ones that are at risk of lower liquidity in the secondary market if this stress event continues. So you'll need to make a decision on how much you want to keep as level 1 and how much is level 2A or 2B based on a potential liquidity freeze in the secondary market and balanced against having more in cash at the central bank just to increase your cash position because we don't know where this crisis is going to go. Okay, any more questions? No, it's my pleasure. I will bid you good day, good evening, or good afternoon. Thank you for joining me. Thank you for your company. Thank you for the questions. If you have any follow-up questions, do please send them to your contact in the BTRM. I'll wish you a good day, and I hope you enjoyed it. Thank you very much.